There is a phrase we use back in the country. It says, be without food, but don't be without shelter or home. Shelter is very important than food, I was working as much as you can work, like 3 jobs. Even with all of those efforts, I couldn't afford to even get a little bit time with the kids.
At the age of 16, I entered the American foster care system. I've pulled myself out of some pretty bad spots, but I needed housing, and what I was making was just not cutting it at the time.
How can a family grow and prosper if they don't have a home that they can afford in a decent neighborhood?
In the past several years, the situation has become more urgent than we've seen even 10 years ago. It has implications for people's lives.
There are so many American families that don't have enough income to afford rental housing. Half of the renters in this country are paying more than 30% of their income for housing.
The low-income housing tax credit allows investors to invest money in housing and get credits, and the result is funds to build additional low-income housing.
The Section 8 vouchers are the primary way to help people afford housing.
Vouchers are a way for a resident to get into an apartment that costs more than what they can afford with their 30% of budget allocated to housing.
There definitely would have been a lot more detours, a lot more failures, a lot more uncertainty.
Now I know that I can enjoy the life, being with the kids, and have a brighter future.
First off, I think housing is a nonpartisan issue, but I certainly believe that the bipartisan approach to solving it is what needs to happen.
Every social goal that we want for the people of the United States revolve around housing. A precondition for making progress is to have a decent place to say, tonight I'm going home to rest.
Good afternoon, everyone, and welcome to the Bipartisan Policy Center. My name is Dennis Shea. I'm an Executive Vice President here at BPC, and I lead the J. Ronald Terwilliger Center for Housing Policy. Though the center was launched in 2021 with the support of housing philanthropist and visionary Ron Terwilliger, BPC has been working on the issue we're focusing on today, housing finance reform, for more than a decade. Back in 2013, BPC's Housing Commission was among the first to outline a comprehensive, consensus-based reform plan for the nation's housing finance system. As we all know, the legislative reforms that followed never made it across the finish line. Instead, this month marks the 17th year that the government-sponsored enterprises, or GSEs, Fannie Mae and Freddie Mac, have been in conservatorship. For some, this anniversary is a reminder of a broken Washington, another year of a conservatorship extending far much longer than anyone expected or intended. But with the Trump administration showing significant interest in reprivatizing the GSEs, the moment for action may be fast approaching. This summer, the Terwilliger Center put together a set of principles for thoughtful, successful exit from conservatorship, built on key areas of consensus that have emerged through years of discussion on the future of the GSEs. Today, we'll continue to build on that foundation as we dig into potential exit strategies, likely challenges, and the potential implications for mortgage markets, the federal budget, and the broader economy. It's a complicated, technical subject, so I've asked all our speakers to please go easy on the acronyms. You can say GSE, but that's enough. In our view, it's important that stakeholders across the housing sector understand what changes might be under consideration and their potential impacts. So I'm honored really to introduce our panelists for this timely discussion. Hugh Frater is the chair of Vessel Technologies, a developer and manufacturer of panelized multifamily apartment buildings. He's also the former CEO of Fannie Mae and a member of BPC's board and the Terwilliger Center's Advisory Committee. Lori Goodman is an Institute Fellow at the Urban Institute and the founder of Urban's Housing Finance Policy. She was also a member of BPC's 2013 Housing Commission. And finally, batting cleanup, we're in the third position, is Ed DeMarco, who is the president of the Housing Policy Council and was acting director of the Federal Housing Finance Agency from 2009 to 2014. And now it's my pleasure to turn it over to my colleague, Andy Winkler, who will moderate this discussion. Take it away, Andy.
Thank you, Dennis, and welcome everybody. Like Dennis said, I'm Andy Winkler. I'm the managing director here of our housing and infrastructure policy work. It's great to have you all here. I don't know which phrase you want to use. We've seen this movie before. It's deja vu all over again. Whatever you say, this is an issue that we've debated and talked about for many, many years, including right here at BPC. So before we kind of jump into the questions, just one bit of housekeeping. If you have a question, we are going to save some time at the end of this discussion for audience questions. And if you're watching us online via BPC's YouTube channel, you can submit a question really at any time in the YouTube chat, and we'll get to those at the end of the discussion. So I'm really thrilled to have Hugh, Lori, and Ed here. You've been part of these discussions and debates, as we've talked about, for quite a few years, and know everything there is to know about this subject. I want to start with Hugh, just to help us kind of set the stage of what the administration is really actively considering in this moment. Via social posts on True Social, media appearances, speculation, now stakeholder meetings. There's this increased interest over the last few months coming from the moves that the administration has made. And the most recent reporting is that they were sort of actively considering some kind of IPO of about 5% of Fannie and Freddie's equity through an IPO or stock sale. I'm wondering if you could kind of give us the lay of the land. Is that sort of the latest thinking? What other possibilities might be under consideration, and what might be the administration's priorities?
Well, thanks for the question, and it's great to be here with all of you. What we know is that there are 10 things that are important, but they're actually easy to remember. So 1 through 7 is what does President Trump want to do, and then 8 through 10 is what's the effect on mortgage rates whenever he does it. But what we can say is that these efforts are serious. There's a strong desire to change the status quo. There's a strong desire to protect the taxpayer, and there's a strong desire to try and lower the cost of housing, which of course is the hardest because the GSEs have a relatively modest effect on that. But there have been a lot of discussions about sale of an equity stake of some magnitude in the two companies. The figures you cited, sale of 5%, numbers of $30 billion have been thrown around, which would make it one of the largest offerings of all time. I think the largest heretofore is Saudi Aramco at about $28 billion. The 5% number would value the companies at $600 billion, which seems impossibly high to me. But having said that, I will credit this administration with being willing to try to do things that others have said couldn't be done. And the enthusiasts for this approach believe it's a good way to establish a price and kickstart the process. And it's possible that a coalition of the willing might be convinced to make an investment in these companies. At the same time, the Treasury has been holding numerous listening sessions. Ed has been involved in some of those with market stakeholders. This includes primary market participants. It includes mortgage-backed securities investors, who are probably the single most important group, advocacy groups on the housing side, consumer advocates, the trades, think tanks on the right and on the left. And I think these are serious efforts. Nothing in the end can happen none of these things can happen without Treasury in the end as the owner of the equity. There have also been one or two, I think it's one so far, listening sessions that have been conducted by the FHFA, and their role is going to be important. As a conservator, they're going to need to plan a path forward as a regulator rather than a conservator. And the agencies themselves heretofore have not been that involved, but they will need to be. The most important thing as you go through this is to end up with a clear business plan that's sustainable, that investors will invest in. And the conditions for that include a capital structure that you can understand and a regulatory structure that you can understand. And all of that is TBD. But I want to make sure that I leave you with the view that there's a seriousness to this effort, and they will try to get something done.
Great, thank you. So Ed, I want to turn to you next, and stick with the IPO for just a minute, because I know that's one piece of a much broader kind of conversation. But on the IPO, just to state the obvious, the Fannie and Freddie are government-sponsored enterprises. They're not normal companies. And at the same time, they're also in conservatorship. Those are two basic facts that make an IPO a little bit unprecedented, a little more uncertain, certainly unconventional. Maybe you could just talk about kind of at a high level, some of the legal, market, and even political challenges that just because of the companies and where they are, that the administration is sort of likely to face as it goes down this path.
Sure. Thanks, Andy. Thanks for having me. Maybe to answer that question, I want to unpack the two predicates that you had to it. They're a GSE and they're in conservatorship. So, Dennis, that was okay. I could use GSE, you said.
Yeah.
But so what is a government-sponsored enterprise? So let's start with that. This is important. What we're talking about is two huge financial institutions operating in the country's secondary mortgage market. What does that mean? Secondary mortgage market is where the millions of residential mortgages in this country, most of them go to get finance. It's where the ultimate financing for your mortgage comes from. There are four basic segments to the secondary mortgage market. There is, on the one end of the spectrum, there is a purely government segment to this market. Those are FHA and VA loans getting securitized through Ginnie Mae. The government is the credit risk holder in those loans. On the other end, we have two segments that are purely private. They operate with private capital without government backing, and that is bank portfolios and then the private securitization market, right? So we get loans that are financed there. GSEs are a hybrid of these two. They are the Fannie and Freddie are GSEs, meaning they got their corporate charter from the Congress of the United States. That corporate charter set them up as privately owned companies. So there's private capital, at-risk, private ownership of the companies, but set these companies up with a public mission and, prior to conservatorship, with an implicit backing of the government. And so that's the hybrid nature of a GSE. It's a hybrid nature of Fannie and Freddie. They're meant to provide the benefits of private ownership, private management, private market incentives, and yet they operate with a government backstop that's not available to any other private companies or private financial institutions. So this hybrid nature is one of the things that makes this whole dynamic of what to do with them so challenging. The second is conservatorship. So they've been in conservatorship since 2008. Right? And so there are two characteristics of conservatorship that are really important to your question, Andy. The first is, what did conservatorship mean with regard to the financial stake of the United States in Fannie and Freddie? So in conservatorship, the Treasury of the United States has an equity position in Fannie Mae and Freddie Mac. That was the rescue that was put in place in 2008. It was done through a class of stock called senior preferred stock, and it operates at the top of the capital stack. So it is senior to all the other equity classes at Fannie and Freddie. Today, the government's equity position in Fannie and Freddie combined is a combination of a $350-some billion, let's call it $355 billion liquidation preference in the senior preferred, and warrants on effectively 80% of the common stock, right? So where'd that $355 billion come from? It came from the $190-some billion of cash the Treasury has injected into these two companies to keep them solvent, and the rest of it is all the dividends Treasury has not received since around 2017 as the companies have been building retained earnings, every dollar of retained earnings becomes a dollar of liquidation preference to the Treasury. Right? These companies only operate since 2008 by virtue of investors in the debt and MBS of Fannie and Freddie seeing that Treasury backstop. That is what has allowed them to operate. So now we come to your question, like, well, all right, well, so that's the equity side. One other thing about conservatorship. There have been a number of reforms done in conservatorship that are really important to the way this market operates today. The development of what's called a uniform mortgage-backed security, a common securitization platform. Both Fannie and Freddie now issue MBS through a common structure. Credit risk transfer, portfolio caps that were placed on Fannie and Freddie, aligning the servicing rules of Fannie and Freddie, aligning the data collection and data reporting of Fannie and Freddie, PMIERs, which is the standard that private mortgage insurance companies operate under, the rep and warrant framework that seller servicers have with Fannie and Freddie. All these are dramatic changes in how this market performs. They've been done in conservatorship, but they've been done by FHFA as conservator. They don't have a regulatory basis, right? So all this matters. Now, sorry to take so long, but this getting this right and understood properly is important to understand why this is so hard, right? So now, what is an investor in a new security offering supposed to understand about the economics of that investment? Well, they need to understand how is this liquidation preference in the common stock warrants going to get resolved? What is the government's priority of claim on earnings relative to some new security class that might be developed? Does the preferred stock purchase agreement that exists today continue to operate as an effective guarantee as we transition into this new state? Or in fact, as the president, I guess, whatever you call his social media posts, because it's a different platform, said, well, there is going to be an I'm telling you, there's an implied guarantee of Fannie and Freddie. Is that going to be it? And if so, is the investor in some new class or some existing class of security from Fannie and Freddie supposed to understand, well, do I have to pay for this, or does it come free like it did pre-2008? What happens to all these conservatorship reforms? Are they now at the discretion of the Fannie and Freddie ownership, or are they going to be somehow made permanent in some fashion? And then lastly, and a key political issue, is what kind of changes the company is going to be subject to in the future, whether that future means future changes from a new administration, or it means Congress finally decides to get in the game and start changing things as well. So sorry for the long-windedness, but
No, that's perfect.
That really
I
is
have
important
30 follow-up questions, but maybe first, I was going to go to talk about the idea of merging the companies into one, but why don't we table that for just a minute and skip maybe to you, Lori, to pick up kind of that point, because an IPO could be part of a broader, bigger process to recapitalize the GSEs and to reprivatize them. But similar to kind of all the steps that Ed laid out, there's a lot of kind of decision points, challenges, issues that the administration will face as they go down that path. I'm wondering if you could kind of go through in a little more detail some of what you think needs to be resolved, because you've written pretty extensively about what's possible.
Thank you. And I'd actually like to pick up where Ed left off, which is in order for
Perfect.
anyone to buy, if you're going to sort of think of, how you really privatize these entities, the question is, what is their business plan? What are they going to look like? So there are actually, in addition to capital and governance, I think the first question is, what is the new system trying to solve for? What problem is it? Who is it intended to serve? What is going to be the interaction with FHA and the GSE and the reformed GSEs, with the private market and the reformed GSEs? To what extent will it have a mission focus? So let me give you a couple of examples where this is really important. So right now, the GSEs do a fair amount of cross-subsidization, where lower credit risk securities are subsidized, where securities with more credit risk are subsidized by those with less credit risk. Cross-subsidization is not normally a part of a truly private enterprise. However, if you have a mission focus, it's critical. Profit maximization might mean competing more with bank portfolios for affluent borrowers. That crowds out the private market. So if your goal is to shrink the role of the GSEs, that would obviously not be desirable. If it's to profit maximize, it would. What product mix are the GSEs going to offer in their new state? Second set of questions, the role of the government guarantee, and new competitors. So right now, the GSEs have a line of credit to the Treasury that totals $254 billion as part of their PSPAs. Will the line of credit stay in place? I assume it will, because that's the only way you can provide the easiest way to provide the implicit guarantee, and certainly the PSPAs allow for it. As Ed mentioned, will it be paid for? How are you going to decide how much to charge for this valuable implicit government guarantee? Will there be one or two entities? It's going to be hard to have more if you have the line of credit in place. And Hugh mentioned this, how will the system be governed? Right now, it's FHA controlled. Who will the regulator be? What happens to the government's liquidation preference and warrants? Sort of what does the capital structure look like? But it sort of goes to the heart of what the government role is going to be. And then finally, the impact on the MBS market and mortgage rates. What return on capital are you going to permit the shareholders to have? Because that directly translates into the return, into the cost of the cost of a mortgage. A utility type rate of return would raise mortgage rates about 13 basis points. A fully privatized rate would raise mortgage rates about 25 to 30 basis points by our calculations. Another set of issues, right? There are sort of three major holders of MBS. Depositories control about 35% of the market. The Fed controls about 25% of the market. And foreign entities control about 14% of the market, or own about 14% of the market. Each of those obtain some benefits. So for depositories, they get favorable capital and liquidity requirements. They have an exemption from the single name ceiling. Will that continue? Will the Fed be able to continue to buy securities during times of crisis? Will foreign entities believe the guarantee is strong enough for them to continue buying? And this is really critical, because if any one of those guys sort of drops or changes their role, that could widen mortgage rates very considerably, well above and beyond the widening due to the cost of capital or the cost of the implicit government guarantee. And then another point is the MBS daily turnover. That is, if you look at the turnover of mortgage-backed securities, it's about 3.5% of outstanding mortgage-backed securities. It's very similar to treasuries. The reason you have this type of liquidity in the mortgage market is because all securities of a given coupon are fungible. They can be delivered into the single security that Ed mentioned. That produces narrow bid-ask spreads for investors. But importantly, from the borrower's point of view, it produces the ability to lock mortgage rates. That would not be there were it not for the very, very liquid markets. Now, the single security, of course, requires Fannie and Freddie to align their policies. This might be considered a collusion if you had two completely separate enterprises. So there are a lot of considerations. And then, if I were to break it down into three buckets, it's first, what is the system solving for and who is it intended to serve? Second, what's the role of the government guarantee, and new competitors? And third, what is the impact on the MBS market and mortgage rates?
So a few things that could go wrong, a few things to think about. I don't know, maybe we turn to Hugh. I think we focus a lot on all of those risks, as we, rightly should. The companies are important, the mortgage market is important, it impacts all of us. But what's the upside? I think we are so heavily focused on kind of all the things that can go wrong. We're kind of missing what is the potential and what rationale might the administration have to go forward.
Well, again, I think that there's a strong desire, as I said earlier, to not accept the status quo. I think there's one purely ideological reason, which is, if it had been our intention to nationalize the housing market in 2008 and not tell anyone, maybe it's time to tell people. I think that And there are people that have a view that, you know, the government should not be as involved in housing, and ask the legitimate question, what do we get for it? And the only thing I agree with everything that Ed and Lori has said. The only thing I disagree with and Ed a little bit is that the banks are somehow the private market. We have this category of bank called too big to fail. And if they're not federally subsidized, why do they have to be bailed out every 10 years? So that's just for another time. But what you do hear a lot is, you know, what problem are you trying to solve? The markets are functioning well. Mortgage rates are higher than they were, but that's driven by interest rates. And spreads move around. That's partly a function of the G fee that's charged. But what investors who buy the securities are paying for is that they're paying to accept prepayment risk and liquidity risk. So the single most important thing that Lori mentioned, in my opinion, is liquidity. But you know, people will ask the question: how will eventual recap and release help someone afford a home or get a lower mortgage rate? This is kind of the do no harm school of thought, which has a lot of appeal to people. Anything that potentially damages the brand value of agency MBS and the TBA market is to be announced market that Lori mentioned is not helpful. You know, if, for instance, the exits somehow reduce the confidence of the 15% of MBS buyers that are foreign and tilted them entirely towards Ginnie Maes that have an explicit guarantee, then that would have a negative effect on spreads. But on the other hand, I mean, the fundamental reason to do this, apart from the ideological reason, is that ending conservatorship and releasing them is to make them better and more profitable companies that are more responsive to the market and less risky to the taxpayers. And don't get me wrong, there's great work being done even inside conservatorship. There have been tremendous reforms that have been made, and you have to figure out which of those reforms need to be enshrined in an ongoing preferred stock purchase agreement, as an example. But you know, the question I always ask people is, when was the last time you bought a phone from a not-for-profit phone company, or a car from a not-for-profit car company? You know, the private sector will ultimately, with the right conditions precedent, the private sector will do a better job managing these companies and protect the taxpayer.
I want to stay with you for a minute, Hugh, and start to dive into some of these more kind of technical questions about some of the potential obstacles that the administration might face. I think one of the bigger ones that people think about is the implicit guarantee or effective guarantee, and how, assuming that Congress doesn't suddenly act to make it more explicit, that how will that guarantee be perceived, with the IPO, and if they exit conservatorship? How do investors, how would they perceive the companies?
Well, for a long time, the mortgage-backed securities investors were insisting that any solution be involve an explicit guarantee, and that Congress would need to act to affect that guarantee. Their story has changed quite a bit over time, and you don't hear anybody talking about that anymore. And maybe it's because they don't have a lot of confidence in the ability of Congress to come together on something like this. I'm not sure. But what they are all consistent in saying is you don't want to damage the brand value of MBS in the TBA market. You want to make sure that liquidity is maintained. There are lots of things that affect that. Lori mentioned some of them, the concentration limits that the banks would have, how are they treated in the repo markets. All of those things are essential to maintaining liquidity. The universal mortgage-backed security has been, I think, a positive thing. What it mainly did was get rid of the subsidy that used to go from Freddie to Fannie. But today, 10% of the market is private label securities. It's the highest it's been in a really long time. I think 50% of the trading volume is specified pools. And so, meaning pools with very specific characteristics. And so it's possible that the liquidity of the market has been dramatically improved by UMBS. It's possible that it hasn't. But either way, it needs to be maintained. If I will say this to Ed, if the liquidity is unchanged post UMBS, I want my money back at Fannie Mae, the money we invested in it. But that's another topic. Honestly, Fannie and Freddie is not well understood. But when I was in the investment management business, every set of investment guidelines that I wrote always said the same thing. Fannie Mae agency securities do not have the full faith and credit of the United States government. They have never had it, ever. And so I think that, the only ones that do are FHA, Ginnie, VA, and USDA. The timely payment of principal and interest is guaranteed by the enterprises, and it's not guaranteed by the U.S. government. The implicit guarantee, which Ed referenced, is the idea that the U.S. government will step in times of stress. And interestingly, if you try to see what's the value of the implicit guarantee versus it's clearly valuable to the enterprises. They enjoy a cost of capital below that they wouldn't have in the purely private sector. But then you say, how much more would they get from an explicit guarantee? The interesting thing about that, for a variety of reasons, 30-year Ginnies and 30-year Fannies and Freddies trade on top of each other all the time. And so it's not obvious to me that there's a big pickup by getting an explicit guarantee. But if you want to protect the system going forward and give confidence to investors, you need to have four things. You need to have robust capital standards, and we're well on our way to do that through the ERCF. Strong prudential regulation, but not conservatorship. More private capital taking risk ahead of the taxpayers. Ed mentioned credit risk transfer. We've got a robust private mortgage insurance business that's supported by robust capital standards in the form of PMIERs. You need to have all of that, and then leave in place the preferred stock purchase agreement, which is, after all, the place where you govern the portfolio sizes of the GSEs. For those of you that are my age or older, you might remember that, and Jim Lockhart is here somewhere, remember that these enterprises developed, because of this advantageous cost of capital unique to them, they developed huge investment portfolios, and they were basically government-sponsored hedge funds. And if you go back, if you are a historian and you go back and you look at their financial statements at that time, you'll notice something very strange. Their guarantee books, the mortgage portfolios that they're guaranteeing, are not part of their GAAP assets. Because it wasn't until FAS 166, about 3 or 4 years later, that they incorporated those guarantee books into their GAAP financials, because they're at risk for all of it. These are giant insurance companies. They're at risk for all of that. So I think that the preferred stock purchase agreement needs to remain in place. And there is a question that's come from investors saying, well, is that $254 billion, is that adequate? My answer is, and I mean, maybe there are people that disagree, but my answer is it's pretty easy. It's about 3% of their current guarantee book. And this is a guarantee book that has a 50% mark-to-market LTV. It has a 56 basis point senior serious delinquency ratio. And that 3% PSPA is in addition to all the other capital that they're accumulating and all the other private risk sharing that they're doing. So I think these enterprises, honestly, will be dramatically overcapitalized. And I think that but it is, I don't want to say it's a no-brainer, because nothing is, but it's essential that the PSPA stays in place. But if it does, there will be adequate support for investors. And if people really don't believe that, and they say, look, how good is this implicit guarantee? Well, I guess I'd say things like, well, we bailed out the uninsured depositors of Silicon Valley Bank. We bailed out Carnival Cruise Lines. We bailed out the auto companies. We bailed out the airlines. I think the implicit guarantee has value. In any event, I think you can, with an explicit paid for PSPA, and the question is how much do you pay, and so on. The PSPA, as it's currently constituted, it has to guarantee the existing portfolio. And the question is, does it stay in place as the portfolio rolls and turns? But I think that the idea that, and with all respect to my colleagues, the idea that mortgage rates are going to blow up. I mean, if people say rash things and do rash things, there's a possibility. All the things you said have to be true, but a mortgage-backed securities investor is taking two risks. They're taking prepayment risk and they're taking liquidity risk. If we've done the things we need to ensure that liquidity risk is not affected dramatically, exit from conservatorship does not affect prepayment risk at all. And what's the other thing that determines mortgage rates? The 10-year Treasury. Exit from conservatorship does not affect the 10-year Treasury. So if you really want mortgage rates to go down, you need to host a recession, and that'll help get them down pretty quickly. But in any event, I think the concerns are, in my opinion, I'm maybe on an island on this. I think the concerns are a bit overdone.
I'm trying to decide where to go from there. Lori, I think, and Hugh mentioned a couple of kind of essential elements that he said the administration would need to keep that implied guarantee moving forward. One of those that I think is another kind of point of contention, in addition to the guarantee, is just capital. Not only the question of how much capital is enough, which is always a question. It also has to do with our perception of the Treasury's holdings being repaid. So maybe you could just walk us through kind of just the capital that they have now, the numbers, how the companies look, and what it would take to be adequately capitalized.
So let's sort of talk about the value of the Treasury's holdings, and I'm going to sort of geek out for a second. 'Cause it's by inner nature.
None of this was geeking out before this.
So the 2024 profit of the GSEs was up about 28.9 billion. 2023 was 28 billion between the two of them. So let's just give them 29 billion. The price earnings ratio of large banks is about 14.5. So that gives the companies a value of 420 billion if you assume they are able to assume the same PE ratio as large banks. However, the GSEs are going to be more heavily regulated. So the PE ratio might be, say, 12 rather than 14.5, which gives them a value of around 348 billion. Let's just average those two numbers and call it 384 billion. So Ed mentioned the capital stack. The GSEs have the senior preferred stock on top. Then there's 33 billion of junior preferred stock, which is owned by the private sector, and then you have the equity, of which the government owns warrants. So the GSEs have 33 billion in junior preferred stock. These would it's very so there are two ways you can sort of create new entities. One is to do a recap and release. The other is to run the GSEs through receivership. Receivership is actually very prescribed, and it's actually a fairly risky endeavor. So my assumption is that they would end up doing a recap and release at some point if they go that route. So the junior preferred would end up being either monetized or part of the new capital stack. So the value of the GSE equity is on the order of 350 billion. Remember my 384 billion average minus 33 billion. The Treasury, as Ed mentioned, has warrants to purchase 79.9% of the common stock at a nominal price. This conversion would give the government 7.2 billion shares. The private sector has about 1.8 billion shares, so the total is about 9 billion shares. The government also owns the senior preferred stock, which Ed mentioned as well. This initially totaled 191 billion. It's since grown to 355 billion. There's no conversion price specified, but most of the value of the companies is in the liquidation preference, and it would have to be converted to common stock to attract economic investors. And in fact, this was done during the auto bailout. So let's follow the Congressional Budget Office and assume they convert the original 191 billion at $2 a share. You can assume they convert the entire 355 billion at a lower price. It just doesn't matter. But let's just do my math. There'd be about 95.5 billion shares. And the government ownership would be 98% of the equity. 91 of this is from senior preferred stock. The implied, so the government would own, so the Treasury's value would be roughly $343 billion, or 89% of the total value. However, this is based on current earnings. There are levers to increase or decrease GSE profitability that are worth talking about. So first, as Hugh mentioned, you could reduce capital requirements. That would allow for a higher price earnings ratio and increase the government's value. You could increase earnings by raising G fees. That's very unlikely because if you increase the G fees, you increase mortgage rates. Items 8, 9, and 10 on Hugh's list don't increase mortgage rates. You could increase earnings by allowing for larger investment portfolios similar to what they had before the financial crisis. The mantra was privatize the gains, socialize the losses. One of the things, and Ed mentioned this, the credit risk transfer has been a very, very important development, and actually that started when Ed was head of the FHFA, where the GSEs started doing risk sharing. Well, obviously, the private sector demands a certain return to own that risk. The GSEs could increase their earnings, becoming more risky by retaining more risk. That's another lever. You could also reduce capital by cutting mission loans that have a lower return. That would not be socially advantageous, but certainly that is a possibility. So when you think about what the GSE's current earnings are, it's important to think about the fact that there are a lot of levers that could increase or decrease that, making the value of the companies very, very different.
All of which, though, affect sort of the political risk of some of this, right? To your point, raising
Yes.
G fees, some of these are kind of not really on the table.
Yes.
And also affect the timing of this, which we haven't really gotten to. But if you tried to change capital requirements feasibly, you could move more quickly to get an exit to conservatorship, right?
It would take about, if you were to go through the normal procedure to change capital requirements, it would take about a year to go through.
Just for the rulemaking.
Just for the rulemaking.
And it would be, if part of your effort was to change the footprint between FHA and Ginnie, you'd have to wait for the portfolios to turn over. It's not going to move on a dime.
Ed, I wanted to turn to you first if you have any reactions to all of that, or...
How much time we have?
Yeah. Why don't we start there then?
Yeah. So let me come at this from a different angle. 2008, Fannie Mae and Freddie Mac went insolvent. Their shareholder equity was wiped out, and the Treasury started a several-year process of pumping over $190 billion into these two companies. They have operated since September of 2008 solely because the taxpayers of the United States, represented by the Treasury Department of the United States, has backed these companies. Right? So that's fact one. And so what happens here in any of these kind of scenarios of ending conservatorship and moving on? I think the American taxpayers owed an answer of, how do I get my money back? Right? My $355 billion, how am I going to be protected, or what's my consideration here? Second, credit risk transfer is actually a very important part, I think, of sort of the future of these two companies. Up until conservatorship, Fannie and Freddie bought all these mortgages, packaged them into mortgage-backed securities, sold off the securities, and retained basically all the credit risk itself. So you had all the credit risk on half the mortgages in the United States residing on two balance sheets with two chief risk officers, two boards of directors, and so forth. Well, we saw what happened, right? So diversifying that risk, spreading that out through credit risk transfer is really important. But what's going on right now, we're not really transferring risk, because this program has evolved in conservatorship over the last several years in a way in which the amount of risk actually effectively being transferred is much smaller than in the early years, and much smaller than what's been envisioned. So I think CRT has real potential here, but we got to get back to the, to a regime in which we are actually transferring risk. And lastly, any discussion about capital requirements of Fannie and Freddie being too high, I'm sorry, but I just have a different point of view. These two companies are systemically important financial institutions. Their failure in the September of 2008 was a major, not a sole, but a major contributing factor to the great financial crisis. And the idea that we would, and part of what drove that was that they had minuscule capital requirements. And so we've currently are financing nearly 50% of US residential mortgage debt through these two companies. And I think the idea of having robust capital requirements with robust CRT is fine, but the idea of trying to get the economics to work by lowering capital requirements, not necessarily what my colleagues are suggesting, but there certainly are people suggesting it. And I think that needs to be avoided at all costs. We need to have some reasonable harmony between the capital requirements that Fannie and Freddie have for holding mortgage credit risk and what large banks have to have for holding mortgage credit risk, large banks also being SIFIs. So I think all of these things need to be factored in here.
The only thing, just to
yeah, go
drop
ahead.
in there, one of the things that's happening right now, as you know, is that the banks are arguing for relief under Basel to get lower capital requirements for holding mortgages. So it's going to, I think they should, I agree with you, it should be harmonized.
So here's
Yeah.
here's the deal, right? I mean, I think here's where Hugh and I think will really agree, right? That like this ought to be empirical. There ought to be a lot of analysis done of mortgage credit risk, and then get some reasonable harmonization. But when you've got a financial sector in the United States where one set of regulators say, here's this generic mortgage, and the capital on it ought to be 3%. And a different regulator looks at that same mortgage and says the capital to hold this mortgage ought to be 6%, right? That's problematic. Right? These regulators have got to come to some agreement about understanding mortgage credit risk and figuring out what's the appropriate capital level to back mortgage credit risk.
Which is one of the reasons there's an idea, it's not a new idea, but an idea that's been talked about over time is to, I hope I'm not offending anyone, to merge the FHFA into the OCC. And that would produce that harmony, I would think. Yeah, assuming that they weren't set up as separate silos inside the agency and they never talk to each other, but assuming they could be merged properly, it could
Well, I
work.
mean, I think that's well worth considering, Hugh. I mean, think about, let me take it a different way. If in this future state, we're all talking about there's going to be continued Treasury backstop of Fannie and Freddie in whatever transition there is, then the Treasury Department, if they're going to take on that kind of contingent liability, whether it's implicit or explicit through a PSPA or whatever, ought to have a greater say in sort of how these risks are overseen and managed on behalf of the U.S. taxpayer.
I want to stick with the, because you brought it up in the first question you answered, which is many, many changes have been made to Fannie and Freddie in conservatorship, mostly at the direction of their conservator, using the powers of conservatorship. Those don't exist outside, those authorities don't exist, that framework doesn't exist if the companies are not in conservatorship. So can you talk just a little bit more about kind of those essential elements of a sort of post-conservatorship regulatory system, and how you get there from where they are now?
Yeah. Well, I mean, it sort of depends upon what are the characteristics of the release. Obviously, certain of these things are a lot easier done if the Congress of the United States would get involved, because then they could legislate a number of these things and we would have both clarity and long-term certainty. But, you know, I think both Hugh and Lori have mentioned, I mean, the idea of in sort of whatever this evolution is, if there's some extension of the Treasury's senior preferred stock purchase, you'd amend that again, and presumably, you know, some of these things could be codified in that backstop. So that would be another way of doing it. You know, probably a weaker form of this is some form of a go-forward consent order that directed that these things be done. Consent orders are not, you know, don't have necessary end dates to them, although we don't think about consent orders lasting for 20 or 30 years. But those are the sorts of things that could be considered. And so that's on the you know, these conservatorship authorities, and then we've already talked about the regulatory piece. Let me say one other thing about the regulatory piece since you raised this. I mean, the important thing about FHFA to consider is FHFA has now been around for 17 years. For 1 month, it was a safety and soundness regulator, and for the rest of that 17 years, it's been a conservator. It's been operating these companies in the public interest as a conservator. And to revert back to now needing to think about themselves as a prudential regulator dealing with companies that are now, again, privately owned, privately operated, and managed is going to be an enormous change, and one for which there's probably a lot of maturing or developing at FHFA, simply because that hasn't been, you know, the core activity. The core activity's been acting as conservator.
And you know, so I think to that point, you know, one of what you worry about with sort of continued conservatorship is that continued bureaucratization. However, you know, the FHFA has done a very, very, very good job through time of having these organizations evolve to meet the continuing need of the market, to meet the continuing need of borrowers. You know, sort of, I mean, you talked about the single security, CRT. I would add to that list the enhanced loss mitigation waterfall, which has been tremendously important. sort of more recently, some of the rent reporting to allow more borrowers to qualify for mortgages by considering their single largest payment, their rent, as part of their ability to repay. So, I think the GSEs have, the FHFA has done a very, very good job of allowing these entities to evolve during the conservatorship, to the credit of the very capable FHFA directors through time. And I think that's critical, because that's one of the things that people say, oh, well, you get all this innovation upside. Well, you've actually gotten a lot of innovation during conservatorship.
With no offense intended to anyone, you could get more. That's my strong point of view. But I mean,
You could get
you could get more.
could-
And
you
there was
could get more.
I was there at this time. There was an explosion of, I mean, after the sad demise of George Floyd, there was inside both enterprises, there was an explosion of idea generation and what can we do, and rent reporting, came out of that. But the fact that if you think about yourself as a private company, you'd tell your board of directors what you're doing, and they'd get excited, and they'd maybe offer some comments about risk and capital requirements and so on. But then if your board of directors has to go to another board of directors to get permission to do it, it just becomes a little harder. And again, with no offense intended to industry, if industry is looking at every single thing you do, saying you're moving the punch bowl or you're changing the level of the subsidy that we benefit from, that makes it even harder. And so I firmly believe that again, I know this is too intangible to be worth much, but they'd be firmly better off, subject to all of the protections and everything we've said, firmly better off from an innovation point of view in private hands.
I'm sure they would be, but I think that they've done quite a.
I agree with
in
that.
public
I
hands.
do agree with that.
I don't think we fundamentally disagree on this
Yep.
point.
So we're going to turn to audience questions in just a minute, so please get them ready. The one thing I wanted to make sure I got in was, we talk a lot about mortgage rates and the potential impact of anything that the administration does on conservatorship impacting mortgage rates. But what are some of the kind of broader other implications of going down this path for the federal budget? Lori, you mentioned kind of the Treasury's holdings. There's one clear dynamic there that is complicated given the GSEs guarantee and how that affects the federal budget, the economy, the mortgage market. Can any of you talk about some of those other kind of potential impacts if done haphazardly, or all of the questions, Lori, that you listed are not answered as they go down this path?
Oh, there's plenty of risk if it's done haphazardly. I mean, nature abhors a vacuum. I mean, if you sort of just did something without adequate explanation, and that's why so much time is spent talking to the stakeholders and trying to understand what the implications have been, and they can take what the stakeholders tell you and discount it by 50% because they're doing what they're supposed to do. But I think that it has to be done. Whatever is done has to be done really thoughtfully. And my personal piece of advice, if the big beautiful offering is what they're really going to do, is in the process of doing that, don't agree to anything that complicates everything else and ties your hands in a subsequent more deliberate release process. Mm-hmm. And that's a risk. And I think that some people are concerned about it, and I can understand why.
So I want to get to the audience questions. We do have a mic for people in the audience. I want to do one from the YouTube chat first because I think it's a great question. Can the panelists discuss release-related actions that can be done administratively versus what requires legislation from Congress? We touched on a couple of them.
Let's start with, what can only Congress do might be the simplest way of getting at this. Only Congress can change the charters. Right? If we release without Congress, then all the charter requirements and rules and so forth stay the same for both good and ill. The thought, had been, when they were placed into conservatorship, that Congress needed to fix these charters. So you can only do that with legislation. Creating a permanent, explicit guarantee of some sort on a go-forward basis can only be done by Congress. Otherwise, you're extending a contract, and now that contract is between Treasury and the companies, And, I would not get sort of, too happy feet about how well preserved that would be over time and how resilient it would be. Only Congress can do things like we created a securitization platform here. FHFA can regulate it because it's currently, co-owned by Fannie and Freddie, right? It doesn't exist in statute other than it's a jointly owned subsidiary of Fannie and Freddie. Whatever happens to that, legislation could, follow that issue. If you did it administratively, you've got a different set of options operating. And if you wanted to do anything changing the footprint or anything else about the mission of these companies, that would have to be done legislatively.
What about redirecting the sort of the proceeds of a stock sale? The idea of putting it into a sovereign wealth fund or anything like that, would that require legislation versus administrative?
I think just on the idea of the sovereign wealth fund, which has generated a lot of excitement and came and went. I mean, to have a sovereign wealth fund, you have to have wealth. We've got debt, so I don't think that's a really great idea. But I do think, I probably differ with Ed slightly. He could be right, but I think some of the things about footprint, those can be done administratively. Things that people do ask about, what about housing goals? What about duty to serve? Those are statutory, but the way they're implemented is inside the administrative bodies, as I understand them. And so I think a lot of the, but Ed's absolutely right. If you wanted to have an explicit forever guarantee, that would have to be enacted by Congress.
Yeah, but you sort of realistically, the most likely path, if you do go the recap and release path, is the implicit guarantee that you clearly don't need Congress for. The lines of credit are codified in the PSPAs, and the PSPAs also allow those lines to be paid for, which you would have to do or in my view, you would have to do if you were to privatize.
Audience questions? Right up front.
Hi, my name's Melissa Lawford. I'm from The Telegraph. I wanted to ask, in the event of an IPO, what is the outlook for the private shareholders for those $33 billion in junior preferred stock? I've heard some discussion saying they're going to make a killing. I've heard other people saying they're going to lose out a lot. What do you think will actually happen or should happen?
I don't know what should happen. So realistically, the question is, do the GSEs actually get recapped and released? I think it is very unlikely they get run through receivership because, again, that is a very risky proposition. If in the event that they do get recapped and released, and in the event that the senior preferred is converted to common, they would be monetized one way or the other. However, that is a lot of if. I don't know what should happen. But it seems like logically, if you were the most likely, if they were going to get recapped and released, which is and right now they do not have enough capital according to their PSPAs to do so. Although again, you could amend the PSPAs, but they do not have enough capital right now according to the PSPAs to do so. But if you were to do that, and if you were to follow the conversion of the senior preferred to common, they would end up being monetized one way or the other. But that, again, a lot of ifs.
Back here.
Thanks. Hi, I'm Matt Axe with Evercore ISI. Just two questions. Could you come back to the question about merging the two entities?
Mm-hmm.
And then secondly, some have suggested that the government senior preferred could be quote unquote deemed repaid. Could you speak to that idea and what you think of that? Thanks.
Who wants to tackle the
I'll
merging
take
the
on
two
them.
entities,
I think
pros and cons?
I think merging them is problematic. They're two separate charters. I mean, this is really more a legal question, but I think you'd probably have to put one of them through receivership and then end up with one charter. I think the pros and cons. There's an old saying around Washington: the only thing worse than two GSEs is one GSE. And you could make an argument for entities that have that are even more efficient than they would be, pro forma for the expense reduction efforts that they're both going through. But this would be if you wanted to keep them in conservatorship forever, one might argue that merging them could make sense, and this would be a massively powerful enterprise. And if you were worried about their ability to innovate,
You should be even more worried about if there were one.
and if the primary market was worried about being disintermediated or having their profits and margins squeezed, they should be really worried about that too. So generally, I would favor two companies. In a perfect world, it would be more than two. I just don't see how that happens. But the two companies can compete with each other, subject to all the subject twos that we said, like Coke and Pepsi, and they can innovate, and they can set G fees at a level where G fees aren't once G fees gets like a Nash equilibrium, right? Once G fees are too high, then the other enterprise lowers G fees to take market share, but they're not going to be so low that they earn below their cost of capital. So that system could actually work, subject to all those things. But the merging into one single gigantic, frightening GSE is both a legal question and also, I just think, a markets question.
Yeah, and if you're trying to sort of increase innovation, make them more responsive to borrower needs, make them more responsive to the to lenders, you want more pilot programs, you want that gentle competition, you want to keep fees in check.
And just let me add one thing to that. And the idea that they become, a lot more efficient, put it in context. The SG&A ratio for these companies, so SG&A as a percent of assets is about 23 basis points. Half of that is not controlled by them. But let's just say they could take SG&A to zero. Everybody would work for free. So that means you could lower, the argument is going to lower mortgage rates. That would lower mortgage rates by, at most, 23 basis points. Not more. 23 basis points, that's it. And the liquidity, and you've already got the universal mortgage security. You've got a single point of failure with CSS. You'd have another single point of failure with this one giant GSE. So I personally think it's a terrible idea.
We're about out of time. We are out of time. So any final thoughts before we quick close? You'll have to answer the second part of that question after this.
No, I appreciate the discussion and the contributions from Hugh and Lori, and I hope that we really do move forward as a country on this, and I hope the Congress of the United States gets involved as well.
Well, we will continue to monitor it from the BPC perspective and stay engaged. I hope all of you will continue to follow our work. You can find, sign up for our newsletter, find other events online at bipartisanpolicy.org. Please join me in thanking our panelists. It was super educational as always. Thank you all for coming. Have a great day.